We're going to talk about the role of taxes and investing. And I think I know what Jerry's going to say about this. He lit up when I suggested this, absolutely lit up. So we are going to answer the age-old question, how to balance, or attempt to answer, how to balance tax efficiency and investment returns and not basically letting the tail wag the dog with regards to this kind of stuff.
Well, for one thing, I think, we in the growth side of our investing, and typically speaking, we have two primary core strategies: a growth strategy and an income, or probably better term, dividend strategy. On the growth strategy side of it, really on all strategies, but it's most prevalent on the growth strategy because those tend to be companies that don't pay dividends. Your return comes from the growth and the value of the business. And because capital gains are treated still, not as much as they used to be, but still treated more, treated better from a taxation standpoint than actual income is. Dividend income, interest income, earned income. And states will vary, and certain tax brackets will make that more or less of an advantage for capital gains. But just by virtue of growth investing, you tend to be more tax efficient. Now, that said, and prior to the last couple of years of underperformance in growth companies in our portfolio too, previously we had like 5 or 6 years of ridiculous outperformance, and a lot of transition that took place from companies that we owned for years and years and years and decades in some cases, had enormous capital gains, which we harvested to put into what we think might be the next 10 years, 15 years, 20 years of great companies. And during that period of time while they're growing, there's very little tax issues because you're just holding positions that you're expecting to be a part of their growth phase. But when you're making that transition, it can be painful because you do have capital gains taxes to pay. So you forget about the fact that it may be tax advantaged. It might be the first time in years and years that you had to pay any taxes on capital gains. And of course, we're talking about taxable accounts, not retirement accounts. But once you get past that, then what's the next level? Because a lot of people will want to, especially it happens at the end of the year. In a year, maybe they have gains that they took throughout the year, and they can, I want to take some losses to offset these gains. I can tell you that in almost 4 decades of doing this, most of the time when that's been done, it was a huge mistake, especially if it's at the end of the year and you're selling to wait. And the way the rules work is, if, say, you still like the company, but the beauty and the curse of public companies is that you can buy them easily and you can sell them easily. And you can buy them back easily, and you can sell them again easily, too easily, in my opinion. But due to that, the rules are that you have to wait 31 days. Well, it's not necessarily due to that. The tax rules are, if you buy a position, you can't buy it back within 31 days. Otherwise, you end up with a wash sale. In order to realize a loss, you can't buy it back within 31 days. Or you create what's called a wash sale, and the loss will be disallowed. It will be as if you never sold it.
It will be kicked forward in time. You could take it at some point, but just not then.
No. If it's a realized loss and you never sell that position again, you will never get to use that loss. Yes, if it's still there in the future if you sell it and then never buy the company back again. But if you bought the company, sold it at a loss, and then did not wait the 31 days, that loss that you were trying to take goes away until you should sell it again. So it's not like you get to use it ever, unless you have to sell the company outright again.
You have to sell it again. You have to realize it.
So the point I'm making, though, is most people will come along at the end of the year saying, I've got these gains, I want to offset. And it's terrible timing because you're selling when everybody else is doing things like that. So normally what we want to do is say, okay, let's think about this throughout the course of the year. And rather than selling and waiting 31 days, now you might do that in a situation where maybe the stock has done really well. Odd that you would have a stock that's done really well and it's still at a loss, but who knows? Maybe it's something you bought at the previous peak. And it can happen. We've seen people, especially in these last 7 years or so, where 5 years ago when things were on our portfolio at the very top, and people came into great companies that were very highly valued at the time. Then they went way down. Now they've come back and done pretty darn well, but they still have a loss because they bought at a very high point. Well, that might be a time that you would say, all right, let's just sell it outright and wait 31 days because it has had a good run. Maybe it'll take the next 31 days and sell off We can come back to it, or maybe it just won't go anywhere and we can buy it back at the same price. What you had to have happen is you sell it, wait 31 days to realize the loss, and then the darn thing goes up. Most of the time, especially because most loss harvesting is happening when the company is down in price. Unless there's something really wrong with the company, my experience over a long time has been when you're selling it, to wait 31 days can be the worst possible and most expensive tax loss you've ever taken. I can't tell you how many times that we've seen companies where it's trading at 20, you paid 40 for it, it's down 50%, you sell it to take the loss. You wait 31 days and the darn thing's back to $35 a share or $32 a share. And what you just lost in value of the company was way more than what you would have paid in taxes, or way more than the benefit that you got from the taxes. What we prefer to do is find different times of the year to be strategic about it. And if we have a company that's down and at a loss and hopefully have cash available, what we like to do is double up on that position, because you can do that, wait 31 days and sell the original share. So you can identify, I want to sell the shares that I bought in 3 years ago at 30 or 40. Let me back up. We doubled the position. So you bought the shares at 40 however many years ago. Now it's at 20. Obviously this requires cash. Take that cash, buy twice the position, wait 31 days, and sell those original shares that you bought at 40. So you're now buying at 20. So your average price is down to 30. You sell the original shares in 31 days that you had bought at 40, and you book that loss. Let's say you sell, and I will tell you, well, I can't tell you how many times we've seen the loss disappear. Worst things could happen. Gee, I want to take a tax loss. Okay, well, let's double up the position. We'll wait 31 days to sell the original shares at a loss. Oops, it's not at a loss anymore. We've had that happen. And that's more common because especially if it's a company that's been hit, chances are it's in a position where it might rally. And when it rallies hard. And it doesn't tell you when it's going to do that. It doesn't ring a bell. And it can happen within those 31 days, especially if it's the end of the year. In fact, that's a great time to do it. So to do that strategy sometimes, because everybody else is selling. And then they want to buy it back in 31 days, say in January. In fact, there's a term they call the January effect, which is often, you get the tax loss bounce, they call it, is the January effect, where people were selling in December to take the loss, but then they're buying back in January 31 days later and the darn thing rallies. Well, then I would rather be on the other side of that. And I'd be buying in December when everybody else is selling. And then I'm selling my lost position when there's strength. In fact, a really great scenario for that is you double the position at 20. Maybe it rallies back to 30. So you still have a loss in the original shares, but you bought the new ones at 20, and now it's at 30. Well, all right, well, I'll sell the original shares that I bought at 40, and I got a $10 loss. I still get to book a loss. And by the way, you get to carry those losses over because you can only use $3,000 worth of capital losses in any year against earned income. So if you have more than $3,000 in capital losses in a given year that are realized, you can roll those losses forward to be used against future gains. And as an individual, I think corporations are limited in the time they can do that. It might be 5 years. Individuals can do that under current tax code indefinitely. So there's a tactic. Now that's a tactic for tax, efficient investing, if you will. But more important, and you probably would gather this from the way I would, the strategy, or I should say the tactic that I've described. We like to say in this shop, do not let the tax tail wag the investment dog. So make sure you're not making tax decisions that are contrary to an investment decision. So if the goal is just to realize tax losses, but you're making a really dumb move investment-wise, then don't do it. The investment decision should be made first. And
if you really don't want to pay any taxes, don't make any money. That's the best.
Yeah,
that's the
exactly
secret.
Right. That's exactly right.
Well, I think this is great advice for people who actually have tax losses. I've never ever had a loss on an investment, so I really don't know. Never. So I can't relate. But for the masses, for the chattel, yes, I think it's a great tactic
for the masses, not the few, the proud.
All right. So taxes, keep them in the back of your mind, but don't let them, again, the tax tail whack with the investment dog, as Jerry said. People do lose the forest, miss the forest. They fail to see the forest through the trees on that many times.
Yes.
And as for the January effect, I think the fact that everyone else is doing it is a good reason not to do it, vice versa. So
most often in investing, that's a pretty good thing.